Everyone, and welcome to our webinar, 5 Key Predictions for 2023 to Tip the Payment Scales in Your Favor. Excuse me. I'm April Grudier, VP of Marketing at BlueSnap, and I'll be your host for today's webinar. Before we get started, just a couple of logistics. First, we will be recording today's webinar and will send out a link post-event. Also, if at any time you have any questions for me, Brian, or Colleen, please submit your questions in the question box to the right of your screen. We're going to do our best to get to everyone's questions, but if we are unable to do so today during the discussion, we will follow up with you post-event. And last, we want to hear from you. So we are going to be running a couple of polls during our webinar, so just be ready to participate. Now, I want to start with a couple of panelists' introductions. I'm really excited to be here today with two of my favorite colleagues. First, Brian Gaynor, our VP of Product for BlueSnap. Brian works out of our Ireland office. And we are also joined by Colleen Lynch, VP of Acquiring and Card Compliance, who works with me out of our headquarters in the States. How are you both doing today?
Great, delighted to be here. Greetings from this side of the Atlantic.
Well, I hope you are both prepared to do a lot of talking. I want to apologize to the audience in advance. I am fighting a cold, so I do have a little bit of a scratchy throat. So I'm going to let, like I said, Colleen and Brian do the heavy lifting on the discussion today. But with that, let's get started. So it is a new year. And this is really the time when businesses are strategizing how to set themselves up for success. And one of the things we at BlueSnap are always advocating to businesses is to think about how you can put your payments to work for your business. Everyone needs to accept payments, but we often see companies ignoring the full potential of payments and how they can drive business. But we see that there's often a lot of complexity around payments to navigate. And in the coming year, we predict that businesses are going to be more focused than ever on how they can manage both the costs associated with payments while making the payment process easier for their customers to increase revenue. And really, the reality is often that these two themes, reducing your fees and creating ease for your customer, can be opposed to each other. And we believe that striking the balance between these two will be crucial in 2023. So with that in mind, I want to start with our first poll. So as we think about payments, what are you most concerned about? Are you most concerned about reducing the fees for payment processing, making payments easier for your customer, or are you equally concerned about both? Let's give everyone a few seconds to go through and select their question.
It's exciting. It's like Strictly Come Dancing or Dancing with the Stars. Who's going to be chosen?
It is, but you know what? People were really fast to put in their predictions or put in their answers, and so we're collecting the responses. Perfect, great. What we can see is, wow, there's a really great, obviously a great balance between people are concerned about both, which is great. It feels like we were on point with our predictions, but I look at the making payments easier for the customer and what a strong showing that is versus reducing the fees for payment processing. Colleen or Brian, do you have any surprises with what our audience was saying?
Well, I'm looking at the making payments easier, and I mean, that makes sense, right? Customer satisfaction drives results and revenue. So I could see that being high. That makes sense to me. Brian?
Yeah, I'm surprised that reducing fees is so low because, a lot of people are focusing on cost at the moment. And I thought that would have been a driver for a lot of people for this year. So that's interesting.
But I wonder if the correlation is if you're making, meeting customer expectations, giving a good experience for your brand, it's going to translate into brand loyalty and in return, more revenue in dollars. So really interesting. Thank you everyone for participating. So understanding that this is a significant balancing act for businesses, we at BlueSnap identified 5 predictions that are going to be driving payments in 2023, which are really going to straddle these 2 goals of fees versus ease. So at a high level, those predictions, excuse me, are embedded payments will eat B2B software. Second prediction, crypto and central bank digital currencies gain notice as low fee alternative payments. The third, open banking gets hyped, but doesn't threaten cards for now. Fourth, strong customer authentication. The contrast between raising conversions and lowering fraud heats up. And our 5th prediction, every smartphone becomes a POS terminal. So Brian and Colleen, what are you both seeing in the industry that is contributing to this idea of fees versus ease right now?
April, I'll take that first. I suppose going back to my surprise about fees, the Boston Consulting Group reckoned that I think they totaled it was $1.7 trillion charged in fees in relation to payments last year, which is an enormous amount of money. And I think it's something that particularly regulators, speaking from a European perspective, European regulators have been very concerned about the cost of payments over the last number of years. And indeed, they introduced interchange fee regulation a couple of years ago. So this interchange fee regulation applies specifically to card processing, and that portion of card fees which relates to interchange, which is what goes to the issuing bank that relates to cards. So they capped it at 20 basis points for debit cards and 30 basis points for credit cards. So that's well into place, but it's had a couple of impacts, and it's kind of coming into this whole thing of ease of use, ease versus fees, that they're trying to cap fees, but maybe it's having an impact on ease of use, because one of the other things that regulators are trying to do is introduce more competition into the market. And sometimes with fees being capped at a very low level, it's very difficult for other competing payment methods to come in and make money and wash their faces and then be adopted, because obviously the more competition there is, it drives that easy use out to consumers. But unless it can be cost effective, that the whole ecosystem can support it, whether it be whoever's the banks or other providers who are providing those payment methods, or the merchants using them, and they're cost efficient, and the consumer, unless everybody feels they're getting value for money, then they're not going to get a trade-off. So there's that trade-off between ease and ease and fees. So really, we'll probably talk more about this later in terms of what the impacts are, because the other thing I see is that fees pay for the ease of use, things like consumer protection. And again, we'll talk about that probably later on with some of the other predictions.
So Colleen, you work a lot with card brands on a global scale here at BlueSnap. Are you seeing these caps everywhere?
Unfortunately, not in the US. So as Brian mentioned, competition, that's a key here. And regulators are looking to increase competition in the US because here we have some of the highest credit card fees. And unlike in Europe and Australia, there are no fee constraints or no agreements as there are in other countries. And so the fees versus ease is the main discussion point here with regulators. Over the last year, card brands increased some fees, reduced others. They contend the results as net neutral. But the looming threat of recession last year, legislators focused on card brand fees under the belief that they're contributing to inflationary costs and that more regulation is necessary to reduce merchant costs. So they're on the merchant side as far as reducing fees. Card brands engaged in the discussions, but they, of course, cited the ease argument. Credit cards, they are the consumer's preference, continued preference in the US. They offer fraud protections. There are security and card benefits. And these benefits, like rewards, are not necessarily available through other payment methods, particularly not cash. So, that didn't end the discussion there. The regulators introduced a bipartisan bill, the Credit Card Competition Act, last year. This bill is now pending in committee. And it's a different approach to regulating fees than what Brian is talking about in the EU. There was not caps. It's similar to what was done with the Durbin Amendment, if everyone remembers, the debit cards, which was part of the Dodd-Frank Act in 2010. And also Australia's done this. But what this act does is, if passed, it would prevent banks with more than 100 billion in assets from only routing credit card transactions through Visa or MasterCard. The banks would be required to enable 2 unaffiliated payment networks on their cards. So either Visa or MasterCard with another network, say like debit networks like Nice or Star, and even Discover and Amex are options, okay? The thought here is that merchants would be able to choose a lesser cost routing option, and this would trigger more competition among the providers. Now, the 100 billion assets, it's interesting, but let me tell you, that is approximately 30 of the largest banks in the US, so that makes up 90% of credit card volume. So if this works, this would have significant impact. But the success of the measure remains to be seen. I mean, will it pass? It, hopefully it'll be taken up this year and we'll see. But interchange fees and assessments can be challenging to understand. And will a business really be able to clearly identify the least cost routing to make that choice at the point of sale, particularly where there are fees and updates? This is a recognized issue in Australia as well, where this is already in place. So it remains to be seen, but the ease in fees discussion in the US will continue this year, and we'll await answers.
Okay, no, that's great insight. Colleen, you specifically mentioned that fees were contributing to inflation, and we know that we've been hearing a lot about the R word recently. Brian, can you share with us how a recession impacts payments?
I think it really just focuses the mind in terms of costs. Going back to our poll earlier on, I was surprised at the fees being so low, because I think we're hearing about all the companies so much in the media around the world that are looking to cut costs, and that's really the effect that I think that this has. So going back to our ease and fees, I think people are looking at the portfolio of payment methods perhaps that they have. What are the ones that I'm paying most for? What am I paying least for? But what are the ones that actually my consumers, my shoppers are using in my cart that's giving me value for money? So I think it's really just prompting people to look at that cost benefit equation rather than being any big ballyhoo about it.
Okay, well, that's great insight. Thank you, Brian. So I want to get started on our first prediction, and our first prediction being around growing revenue through payments. So that is embedded payments eating B2B software. Now, this is a play on the JP Morgan piece, payments are eating the world. Brian, can you talk a little bit more about this prediction and what it means?
Yeah, it's really, it comes down to embedded payments in B2B software. So what do we mean? What do we mean by all this? We see a lot of players that, for example, who provide software solutions to a particular market vertical. For example, schools management. We've one particular merchant who provides that they have a software package that allows schools to manage, their running, rostering classes, looking after, new applications, but also things like, taking the dinner money, the annual school fees, etc. What we're talking about in terms of embedded payments is that module that you need to look after in relation to payments being within a wider package. And we think, it's a double-edged sword. On one side, we see merchants trying to build all of this out themselves, that they're trying to become payments experts in order for their platform to become more common, around the world, and trying to take on all the complexities of payments themselves, as well as build out their platform. Really what we think is that there's the specialists, so like somebody like BlueSnap, who can provide that for you, to be the specialist in terms of embedded payments within your platform. So you look after, your business and growing that out in terms of providing it to your clients, and somebody like BlueSnap can look after the embedded payments. Because there's a lot of things that need to be looked after. On a simple basis, if you're dealing with payments and you're paying your clients, there's a whole things about anti-money laundering and know your customer compliance that needs to be done in order to board a merchant. On the other side of it is in relation to market spread. In order for your product to be successful, you need to be able to offer it in different markets, and different markets have different specializations in terms of payments. So With somebody like BlueSnap, you can get local acquiring in lots of different countries, which gives you the best authentication and authorization rates. And similarly as well, we'll give you the appropriate methods of payments that are popular in those markets that you can do it. It comes back to the adage, you know what I mean? If you're running a business, if you got a package that you're putting out there, if your sink blocks, you're not going to get out the plunger and get under the sink yourself and try and find it. You're going to get a plumber to do that for you. And similarly, would say with embedded payments, that's you should look for that sort of specialization in terms of the product you're looking at.
Brian, I'll just add a little bit and reinforce some of the topics you mentioned. I mean, right, businesses can now leverage this technology. They don't need to build their own solution, invest in tech, but they can get a customized solution with a reduction of costs. And like you said, payment facilitators can take away some of the heavy work, like BlueSnap, to do like the underwriting, AML, onboarding, routing, fraud protection. Those are pretty critical elements that they don't need to worry about. And also, this is a revenue generating opportunity for businesses. So it's an expansion of the company's business model. So particularly too, you mentioned educational and cross-border fees. Well, look at higher educational institutions. There's global acceptance. Embedded payments will allow for cross-border transactions with probably more successful transactions because of the local acquiring without the additional integration. So it's really a positive and exciting opportunity for them. So they can reduce cross-border fees, but also improve greater approval rates for foreign cards. And plus, what's important is the customer experience is seamless. The tech is behind the scenes. So that way, the consumer is coming in, they've got that ease, and that can create loyalty. So it seems like a win.
So Colleen, you were just talking about fees, and our next prediction is about crypto and central bank digital currencies gaining notice in this area. Can you, Colleen, just start us talking a little bit about crypto?
Sure. Well, crypto's here. Lots of people are skeptical and risk averse, but it's a hot topic, and it'll go mainstream, particularly for digital currency with central bank backing, which we'll discuss. So crypto is a digital currency. Think of, for example, Bitcoin or Ethereum, which have been surging in popularity. It is looked at as an investment and a payment option. Okay, we're going to talk about it as a payment option. There are some benefits. It offers anonymity, which a lot of consumers like, but it also offers lower transaction processing costs. But there are risks. It's volatile because the value is based on investors' usage and speculation. And crypto's also held on exchanges. And if an exchange fails, there's a risk of loss. And we all have seen that in the news with the recent FTX failure. That's because crypto and exchanges are not protected by or subject to our traditional financial regulation and consumer protection laws. So fraud remains a valid concern, and where crypto is unregulated and decentralized. But globally, governments have been scrambling to understand crypto and kind of take action. They are in the market looking to develop laws and guidelines to regulate the use, but the acceptance of crypto across the board is not even. Many countries, US, UK, Australia, they welcome it. And we've seen some guidance coming out from them. But other countries, it's still banned. So while crypto's reputation is improving and people are excited about it, it is still not recognized as legal tender, and there's still reluctance to trade in it or to use it because of the volatility. But it's interesting, April, according to payments.com, 85% of businesses with over $1 billion in annual sales accept crypto. And as I said, the fees can be lower. Here's an example, 1% on average compared to 1.5% to 3.5% for cards. And if you're talking about cross-border payments, those fees add up to 5.5%. So that's a pretty significant reduction. So while merchants are still hesitant to accept crypto as payment, the fee reduction benefit is enticing. And there is a population of consumers who want the anonymity that crypto offers. And what's interesting too is with crypto and with card brands, it was thought that the introduction of crypto would be a disruptor, but card brands too have embraced crypto. They've kind of engaged in partnerships, product and service offerings, and advisory services. So it's still live and well. Brian, anything to add as far as solutions is for businesses wishing to engage in crypto as a payment option?
Yeah, I suppose from BlueSnap's perspective in terms of what we do, in terms of doing a payment, I just regard crypto as being another currency. So we can accept 146 different currencies today, and I just regard cryptos as being a different flavor of that. It's a way of transferring value from one place to another. So, we can allow a payment, in crypto and give you that crypto for you to manage, or we can get it converted into a standard currency for you to take that if you want as well. You talked about the likes of the FTX failure and the impact that's had. Obviously there's confidence issues around crypto, but I think it's not going to go away, because it's so easy to use, it's so cheap to use, and there's so much thought being put into how to use it. It is going to become much more common, and I think it'll become more legitimized. So, for example, the types of use cases we see today is, for example, people or businesses in countries that have volatile currencies are using cryptos to make cross-border payments, so that they take out that FX volatility risk in terms of doing that payment. And I think that's a very valid use case for using crypto today. But I think it's going to become more and more acceptable as it becomes mainstream. So, Colleen, I think you're the expert in this. Can you talk about the CBDCs and what they are?
Yeah, and I agree with you, Brian. And I think CBDCs just offer another option. It's more of a stable coin where it's backed by a fiat currency like the dollar and such. And the CBDC in particular is the central bank digital currency. And that's a digital payment solution proffered by the central banks. And it's actually the response to crypto. It's an electronic cash representation of, say, the dollar or the pound or the euro. It stores value and it makes the digital payment seamless. The benefits are it is safe. There's no credit or liquidity risk, so there's no volatility like what you see with Bitcoin and other crypto, and there's no risk of collapse of the bank. It also similarly offers a faster and cheaper payment between countries. It expands consumer access to the financial system and gives a platform for further tech innovation. So they're all benefits much like crypto, but there may be more security where it's issued by, customers may feel more comfortable where it's issued by the central bank. The challenges are, again, the widespread adoption due to trust and data privacy and knowledge about it. Any new solution coming out, people are a little bit skeptical. And there's no card benefits or rewards. And there's also concerns about potential cyber attacks and the policy implications on monetary policy. That's why globally these policy implications and the impact are being considered. And right now, CBDC is in various stages. About 114 countries are exploring it, and over 10 have already launched it. 6 are piloting in 2023 alone. And the US recently has shifted from research into development. So CBDC is a highly significant innovation that warrants attention, but the timing of the rollout and global acceptance is still unknown, but it's only increasing. We'll see more to come in the coming year.
Yeah, so it sounds like we could probably have a whole webinar just on this topic. So that was really great insight on crypto and the central bank currencies. But I want to move on to our third prediction. And Brian, I'm going to come up to you next, so be prepared. So our third prediction, open banking gets hyped, but doesn't threaten cards for now. I want to start with you. Open banking is included as part of the Payment Services Directive 2 that is mandated in the European Economic Area. Can you share what's going on with it in Europe?
Sure. We love regulations in Europe. Now, sometimes it can seem it's just laws and rules, whatever else, but actually, PSD2 and open banking is trying to develop the market for payments in Europe, and that's going to spread around the world. So if you haven't heard about it, what open banking is about is the idea of banks having APIs that allow 2 things to happen. One is that third parties can reach in with the consumer's consent and get information, financial information about that consumer. So what's their spending habits, how much is their mortgage, etc. So think about a mortgage application and giving them full visibility for that. That's one use. The other use, which is the main thing we want to talk about, is the idea of being able to create or push a payment from that consumer to wherever it needs to go. So the idea is that banks need to provide an API that allows a third party to push a payment from my account, for example, to pay for that pair of shoes that I want to buy today. So this is mandated across Europe. Europe has 3,000 banks. The regulation said they all need to have an API, but they didn't say what the API needs to be. So all of the different banks across Europe have different flavors. And it's much more acceptable and developed in some territories than in others. Probably the most advanced is the UK market, because they've got just 9 banks that operate to consumers there. And they came together and they agreed a common set of APIs, and that's probably the most evolved in there. So when we look at the UK market, I think there was 21 million payments made in open banking last year, but that's out of a universe of 40 billion payment transactions that happen in the UK, of which 24 billion were card transactions. So 24 billion card transactions versus 21 million open banking transactions. So it's a factor of 1,000 in terms of the difference. But it's coming. It's coming. So what's it going to do in terms of our ease and fees discussion from earlier on? Technically, it should be cheaper. So it should have a lower fees cost. But remember, I was talking about those other regulations about capping the credit card fees. There's actually very little room for open banking to make money to pursue this. So that's one of the challenges, because when it comes down to ease, one of there's a couple of things around ease in open banking. One is it could be a bit clunky, the amount of authorizations that you need to do in order to process a payment. Now, it's probably best cases in the UK. Some markets in Europe are very difficult in terms of that easy use and clunkiness. But the other aspect that's being seen is around fraud. So there's a lot of discussion, particularly in the UK market, about authorized push payments, where people push money from their bank account, whether it be because of the APIs or they, through other means. But authorized push payment fraud is becoming a huge problem. I think there was £580 million worth of authorized push payment fraud in the market last year. Now, the regulators are coming and saying, well, the banks need to do something to counter that and to compensate consumers. But the problem is there isn't a mechanism to do that in order to pay for it. So with cards and the interchange fees that we talked about earlier on, they pay for the fraud aspect and compensating consumers when something goes wrong. That mechanism isn't in there yet within open banking, so that's going to be one of the drawbacks for it. So open banking is coming. It's a bit clunky. It's going to get simpler over time as people get used to it and make it a bit better. It's going to have fees that are going to be on a par with cards, maybe a little bit cheaper in some circumstances, some in other, but it's still the early stages of adoption. And until we get the kinks knocked out of the consumer process, that instant payments are backing up so that the money transfer happens all the time, I think it's going to be a while before it grows and really challenges and threatens cards, as we say in the prediction. Colleen, do you want to have a chat about, open banking in other markets?
Yeah, sure, Brian. I'll just, tell you a little bit about what I've seen. Now, the UK model for open banking has been a blueprint for other countries. The US is slower to consider, and it's not mandated, but open banking in form has existed. Rocket Mortgage, as an example, is one of the most popular open banking services we've seen. And again, there's still the same in the US, the same fraud concerns. But there's also, it's seen as regulators are seeing it as a solution for giving greater control over their financial data. And there are some consumer regulations already in place to fraud protection. So it's a viable option. Again, like you said, there's going to still be the consumer fear of sharing and acceptance of this concept in the US, where it's new and it's not mandated. And, there's all these, the regulations, people need to understand it. So it's slower to be adopted, but it's moving along in a positive trajectory. And I actually saw a study where in 2023, it continues to just escalate up in 2024. Globally, there are certain countries see it as a tool for financial inclusion, coupled with ease. They also think of it as an increased innovation and tool for competition, a driving force there. And in Latin America, it's interesting. Not only will consumers benefit by open banking, but it levels the playing field for other smaller banks and institutions, rather than the few traditional that dominate the market. So again, there's a perfect example of increasing competition. So, it's a positive, and I think we're going to continue to see more of it, and how widely accepted it is and what the success of it remains to be seen, but it's a valuable alternative payment option to consider.
So, Colleen, seeing this, that open banking may be encroaching on card payments, but not necessarily taking over. What are you seeing from the card brands?
Yeah, it's interesting. Like the crypto, again, not necessarily disruption. Again, it's new. It's not really out there globally yet, but the card brands are supporting it. You know, they recognize it, that it leads to a better consumer experience and, you know, more consumer choices, which is always a win. And they've engaged in partnerships, product offerings, and data services to kind of join in. There's a clear consensus among the card brands, the regulators, particularly in the US, the UK, that open banking is gathering momentum. But like we said, consumers need to feel comfortable and see the clear value of the solution. And once they quickly understand the ease and delivery of payments and what they can do with open banking and the backing of open banking by trusted brands like the card brands and the banks, you know, I think it'll foster success.
Right. Again, another great topic we could probably have a whole other webinar on, but I want to move to our fourth prediction, and let's stay in Europe and with PSD2 a little bit longer. One part of PSD2 requires strong customer authentication. And our next prediction is about strong customer authentication. So when businesses have a choice, will they use it to reduce fraud, or will they choose not to introduce this friction into the checkout process? Brian, let's start with you.
Yeah, this is an interesting one because, yeah, as you said, April, that Europe is the poster child, is the test bed for this, because strong customer authentication has been mandated here. Again, the regulator saying, too much fraud in the industry. You guys need to tackle fraud, so you're going to do strong customer authentication on everybody and every transaction with exceptions. So strong customer authentication is the idea when you're doing a transaction that the consumer needs to prove that they are who they say they are. And typically how that's done is you'll do an online transaction and then you'll be prompted to, do your biometric, do your thumbprint on your phone or your facial recognition to approve that transaction and go forward. So it's been in force fully here in Europe for about a year at this stage. What we're seeing is, yes, it's had an impact on fraud. Fraud has declined as a result. Yay, great. Some people would say it's up to 25% fraud reduction. The problem on the far side, though, is, and it comes back to our ease of use thing, is that we're seeing greater cart abandonment. So people are coming up, they've chosen what they want to buy, they get to the checkout stage, and then they're being asked to do their authentication, and then they're quitting or they can't do it. Now, of course, it's stopping the fraudsters from getting any further, but it's also stopping the legitimate shoppers. That cart abandonment, was quite high initially when it was originally enforced to everybody, and that's come down. There's still some friction there, but people have got more used to it. So there's that balance there in terms of reduction in fraud. The other thing that I suppose the learning here is that there's two things you need to think about. Whereas before we would have just talked about your authorization rate. What's the authorization rate you get in terms of your transaction? With strong customer authentication, the schemes here in Europe will guarantee you an authentication rate for authenticated transactions. Great. However, it fails then to note that you have that other hurdle for that consumer to get through, which is to be authenticated in the first place. So they need to be authenticated. Is Brian who he says he is? And then the authorization step is, has Brian got enough money to pay for this pair of shoes or whatever it is that they're buying? So you need to look at those two things in terms of when you're deciding around where you have a choice in a market to decide as regards about strong customer authentication and what to do with it. The other thing to note is that we're seeing in other markets, particularly in the US, some issuers are starting to return a decline message of 3DS required or strong customer authentication required. The reasoning behind that is that whereas before an issuer would have gone, not sure about this transaction, bit in the dodgy side, I'm going to decline it, and would have just given a general do not honor decline code. They're now saying, actually, do 3DS on it. If you put 3DS on it, I'll reconsider it and I may authorize it the second time around. So it's an interesting one to see that, that what some issuers are doing and may have an impact in terms of how we go forward. So I think sort of in summary on this, from a European perspective, I think there's now people are now reconsidering as regards the regulations. There's talk among that some of the regulators think that perhaps the rules are too prescriptive in terms of how they said everything that needs to be done, and it maybe needs to be a more rules-based system as regards the overall fraud rates and to try and get those down. But the other thing is, coming back to our fees versus ease, we're starting to see now is fees being a carrot and being dangled in order to encourage people to use SCA. So the schemes in Europe are talking about that if your transaction either has SCA or is tokenized, we're going to charge you less interchange and less fees to process that. So that's again an encouragement to make sure that you're using SCA or tokenization as a way forward. That's kind of the European view. Colleen, is SCA happening in the US and elsewhere?
Well, I mean, SCA type requirements are kind of used in other financial transactions, not so much, as you said, it's not really required here in US, but we are seeing tokenization, which is more common, and it's a little bit frictionless. So tokenization replaces the cardholder account number and other sensitive data with the non-sensitive, unrelated data. Like SCA, it reduces the merchant exposure to fraud and compromises, but again, a little bit frictionless. So it's good because it can protect and enhance the merchant's reputation by mitigating brand damage and customer flight if they see failures. And, as you see with 3DS, that may not be there. And like SCA transactions, card brands lower interchange for tokenized transactions. So that's where we are in the US now.
Again, great discussion. Thank you very much. I want to focus on our last prediction for 2023, and it's all around our smartphones, something that we all have and we're growing more dependent on every day. And that prediction is that every smartphone, the prediction is every smartphone becoming a POS terminal. What do you think?
So, April, I think this is a really interesting one, actually, as regards what's going to happen here. So, what we're seeing is around soft POS. And what soft POS is all about, we're probably all familiar with the likes of SumUp or iZettle or Square, where you can have that little dongle that allows you to take a transaction along with your phone. So, you tap against the dongle, then it gets transmitted over your phone and performs a card present transaction. What SoftPOS is doing is actually, you put an app on your phone, but you don't need anything else. You don't need to have a separate piece of hardware, and that literally then, you can just tap it. The consumer would just tap against your phone and the transaction is done. We see this being really exciting from a number of aspects. One is look at the cost of doing full POS. It's reckoned that for example, a restaurant to roll out a till, the initial cost is somewhere between $2,000 and $7,000 for the all-in cost of rolling out a till. Obviously, if you've got a phone that's already in your pocket and you can just provide software on top of that, it makes it an awful lot cheaper. We think it'll move the use of cards into other spaces that don't currently use them at the moment. So think about those who might want to occasionally, do a card charge. I talked about plumbers earlier on. Think about the plumber, your boiler's gone bust and comes around, you want to pay the plumber by card. But rather than them, saying, oh, well, I've got a terminal, let me get it, oh, I'd never charge it, whatever else, they can just get their phone out because God knows a plumber's phone is always on, and you touch against that and your payment is made. So other people or other use cases, so people like tradespeople, taking deliveries at the door, collecting customs fees, Girl Scout cookies, is that what you guys still have in the US?
We still do, yes.
Because every 7-year-old girl upwards has a smartphone at this stage and will be able to collect payments. So whilst we don't think that people are going to throw their cash registers first, we think it's going to just make this much more common. I think it'll have a knock-on effect as well on contactless. I was in the US just before Christmas, couldn't get over that you guys don't use contactless everywhere like we do in Europe. No, you have to go to that till over there, or no, we don't, you can't tap your phone here. I think this will drive contactless further, particularly in the US as well, and be that, be the future. It's going to have a big penetrative impact, I think, soft POS. Colin, any other bits to add on that one?
Yeah, I'll just add a few points just from my own perspective. I think it creates efficiencies too for the businesses, because I think about when you're at a restaurant and you have to wait for the server to go back with your receipt to sign. Well, now some restaurants have the soft POS right there available, and it gives less wait time for the customers, so we have the ease, but it also gets the customer out of there and a new person in. So it has some efficiencies there. And it also can expand a person's business opportunities. I mean, I've been to shows where there's, you know, hundreds of small vendors there that are using these tools and expanding, leaving their shop and having a new venue to offer their goods. And think about pop-up shops. That's really common here in the US. And that's, again, where we see this soft pause. So it's a really viable option for people. And also, just to note, it's not just available for cards, right? It can also use other payment methods, including open banking applications and common methods in the US, such as Venmo, Cash App, and also Alipay. So it opens the door as well to a broader group of shoppers without cards. And where, you know, there may be hesitancy by shoppers with this method due to privacy and security concerns. Again, you see it with all new payment methods. That's being addressed, and I read something that Apple is actually seeking to educate the market, to give SoftPOS a reputation for security and privacy to alleviate these concerns. So, you know, I think we're going to see more of this, and I think the consumer adoption of it and, you know, recognition that it is a valuable option and safe is going to, you know, be increasing.
Right. Well, thank you so much, both of you. These have been incredible insights on all accounts. I want to be conscious of time. But again, this was a great look at our 5 predictions for 2023 that will really help businesses tip the payment scales in their favor, again, balancing between the fees and ease. I do want to do one quick poll with our audience. And so I really want to focus this poll on hearing from you all in terms of what predictions are you most excited to dig into for the coming year? Is it, you know, you're really excited about embedded payments and their impact on, you know, B2B software? Is it around crypto and central bank currencies, open banking, strong customer authentication, or that every smartphone becomes a POS terminal? So some quick results. It looks like, as we have the votes coming in, we have about half of the people have voted. Oh, it keeps moving. But strong.
We should have a separate category for just European regulation because it covers everything.
We could, but it looks like what people are really interested in is strong customer authentication. And what I think is interesting, Brian, is we have seen in the past, like in my previous life, I worked card present, and that the European market was the big driver for the chip and PIN. And, you know, it eventually came to the US and became mandated, but I feel like, you know, is PSD2 kind of on that same trajectory? And it looks like a lot of people, about 36% of the people taking our poll, are really interested in that topic, along with, again, you know, a smartphone becoming a POS terminal. And again, I think that goes back to my earlier comment about how dependent and how multifaceted this piece of this device has become. And then third, you know, about 18% of our voters really looking at how embedded payments can impact B2B software. So Colleen, Brian, any surprises here about where people are thinking or what they're thinking about for 2023?
I think the strong customer authentication is interesting because I think with what's happening here in Europe, everybody's trying to make it much easier. And, you know, in comparison to, we say 5 years ago when the draft regulations came out, people said, how are we going to do strong customer authentication? People are using it today. It's available on phones. The biometrics are there, and there's much less friction than was originally hyped. And I think in markets outside of Europe, where people want to lower fraud, it's an option now where it's not as scary as what it used to be. You know, 3DS 1.0, you know, 3DS 2 now, and what's available is much more consumer friendly, but it's really attractive, whereby if you've got edge cases that you're concerned about a shopper, well, actually I'm going to present 3DS and strong customer authentication in this situation and not in another, or for particular verticals where they might have more fraud, and it can be chosen. And I think that's it. It's really balancing that, raising conversions versus lowering fraud. So it's interesting to see that people see that as attractive.
Yeah, I think it's also interesting because, sorry, Colleen, is that it's that two-factor authentication is becoming more ubiquitous in other things of our life. So, you know, I think about, you know, if I'm logging into, you know, a program, or I'm logging into my Google account from another device, it's becoming muscle memory for me to do that second authentication. So for payments, I think it's becoming more intuitive that people kind of expect that they probably need to do that.
Yeah, and I was just gonna say too, I mean, a little surprised, but not necessarily, because really what this says is merchants are aware of the fraud costs businesses. And that's something they need to, we're talking about reducing fees, but that's another channel to bring in revenue and reduce loss. So, it makes sense.
Right. So again, being conscious of time, we did have a couple of questions come in. We will address those post webinar and offline. I apologize, but we are at time. So again, thank you so much, Colleen and Brian, for taking the time to talk about this idea of fees versus ease. I really appreciate you taking the time today and joining us and offering your expertise. And for our audience members, if you're looking for any more information, please visit BlueSnap.com and check out our resource center. It is filled with great information about how you can make the most of your payments in 2023 and beyond. So again, thank you for joining us today, and we'll join us for another webinar soon. Thank you.
Thanks, Doug. Bye.
Bye all.